Okay, so here's, if we opened it on Wednesday, a weekly collar where we only got 59 cents up front for the 57.5 call, and we paid 18 for the 56. So it's a 1.6% maximum risk with the potential for a 1% return for a 4-day trade. Now, as Paul mentioned via his email, in certain accounts he can't roll the put, and as we saw, it only has a bid of 0 and an ask of 1 because it's so far out of the money today. That's where we saw it at the close. But during the day, if the stock went up to 57.60, the market maker might have put this up at 18, 19, or even 20 cents. So I'm giving back almost 1/3 of what I originally collected on the position. But then, of course, it drops back down to 57.40, and it might only be 8 cents to buy back, or 9 cents, let's say. So that might be a good time if you catch it in time. So, sorry, folks, I didn't have that scrolled down far enough there. So let's take a look at that again. Here we are in a weekly collar. And the first thing I say to Paul is that when he looks to maybe buy that, and maybe if this went up to 58 even, this might have cost me 70 cents to buy back, more than I originally received for the call. Okay? And he had mentioned that in the 401k and some accounts, he can't roll the put. He's not allowed to roll the put. So the first thing I'd say in regards to this is that if you're concerned about the buyback being expensive because you only collected 30, 40, 50 cents or 80 cents on the position because it was a shorter term collar, meaning you just opened it this week, well, I hate to say it, but that's the cost and the outcome of trading weekly options. Meaning that even on bull put spreads with relative probability and what looks like a good return, a 5, 8, maybe 7% return for a 4-day trade, well, you're only getting 10 or 15 cents. So if the stock goes 10 or 15 cents below the short put, you're paying back exactly there what you have to do, exactly what you collected to buy back the position. Okay? All right, so that's one thing. This is the price of trying to do short term and only receiving a small premium up front. On my example, if the stock ran up to 58, now you did mention, Paul, that if you knew it was going to be above, that you'd let it get a sign. But if mine was bouncing between 57.20 today and 57.80, I'm balancing between a buyback of 9 cents versus maybe even as high as 60 cents when it was up at 57.80. And that's the price of only receiving 59 cents up front for a 1 week out or even a 2 week out trade. Lower premium means it kind of hurts more when you have to buy it back. Now, number 2, Paul, you had mentioned that in some accounts you can't roll the put. And I'd say that's perfectly fine. Okay? In this situation, I wanted to roll the call. Let's say I found a reasonable time to roll my short call on this collar or to re-bracket the whole collar for the next expiration out to the 26th of January. Well, you were planning on giving up this full cost of the put anyway, right? The best case scenario, what happens is your put in the collar goes to 0. So just let it go to 0. And what you could do then is just roll your call if you think it's not going to be assigned or you don't want to pay the cost. Yeah, you're paying it back, but we could, even if I paid 60 cents to buy this back and sold the next week out 57.5 for 70 cents or 80 cents, not a ton of profit, but I'm still around the same range. Okay? So in this situation, keep the stock, roll the call for a credit, naturally. I wouldn't necessarily go to a higher strike price unless you're really bullish because you might be rolling for a debit. Buy the next week out put to complete your collar. So at that point, right before close, you have one short call against 100 shares and 2 puts, one that's expiring today and one that's in place for next week over the weekend while you're holding the stock. If you can't roll it, well, you're expecting it to go to 0 anyway in the best case scenario. Roll your call, buy the put for next week's expiration, and just let this one disappear. You won't get penalized for that. You will lose the full 18 cents, but you're planning on doing that anyway. You might have paid another 18 or 20 cents to go out further as well. Okay, so that's how I kind of approach it. If you're only doing weekly options with covered calls, with collars, even with bull puts and bear calls, when it comes time to manage them, I hate to say it this way, but it sucks. It will suck because you only took in a small premium. On a bull put credit spread, which has a similar risk-reward profile, I might have sold the 55 on AMAT and bought, let's say, the 52.5 for a bull put. But this might have only been a 12-cent net credit, 15 cents for a 4-day trade, something along those lines. Well, if the stock dropped down to 54.80, which wasn't that far of a move from how this stock moves, I should say, but yeah, it's a 3-point move, but if it dropped down to 54.80, well, I'm paying 20 cents. If you think about it, from the net credit I could have received, that's more than a 50% loss. Not a 50% loss on your difference in strike prices, which is how we really account for it, but looking to make 12 cents and then having to close it for 20, you gave back that whole 12 cents plus an additional 8. So 50%, more than 50% more than what you originally received, you paid back to close the position. You'd probably just roll it at that time, maybe to a 52.5, 50 for the next week to get another 30 cents to counter the loss we took here and still have a decent premium if you could roll it. But on those positions where you can't roll it, the collar and the 401k, you can't roll your put, I would just leave it there. And if you're going to stay in the position and roll the call for the next week out, then do that. If you can catch it at the right time, and I know it's hard, but I mean, if you're in one of these balancing acts, and I've had this in my account too, watching a position, is it going to get assigned, or do I have to roll it, or just let it expire? But if you're worried about holding the stock over the weekend without the protection in place, as I mentioned, try to find a good point to buy back the call where it's not too expensive. So roll the call if you can at the cheapest price. And I'm sorry, but with the weekly options, we all know we have to watch them more carefully because we're battling really a nickel loss to someone who's trading a 3-week out or 4-week out trade would say, oh, it's not too bad. I paid 5 cents more, or I closed it for 10 cents, but I received $1 up front. But when we do the weeklies, you're talking about only making 10, 15, 20 cents of premium. So 10 cents is a huge deal. It's 50% of what you've got there. So that's the challenge, and that's what you have to face when you're trading the weeklies. But if you're watching the market all day because you're worried about this anyway, I wouldn't say set a contingent order and walk away because you might never get filled when you wanted to close the position. But look for a good time when you can buy it back. When the stock here, this stock was down at maybe 57.30 or 57.40, this might have only been 15 cents. It's expensive from what I received, 1/4 of what I received, but I've got to accept that because I'm trying to maximize return and sell week by week by week, realizing I'm only getting a smaller premium to begin with. So that's the battle you have to fight. And when you're rolling the call, just buy the extra put to complete the collar for the next week out for Jan 26 if you're sticking with the weeklies there. So you'd roll the call, buy the extra put, and you still have this put in place, let it expire, so over the weekend you don't have a covered call or a long stock that's unprotected. And that's my suggestion to you with your issue heading into these small problems. I don't want to say small problems, I meant, came out wrong. What I meant to say was small premiums in that case with using the weeklies and then having to roll them long term. Okay? All right. So let's go in order now to our questions that came in. We've got several to go through here. David is up first. His first question when the webinar first started is, what is the difference between IWN and IWM as in Mary? Okay. Well, whatever they determine that is. Okay. So the IWM is the iShares Russel 2000 Value ETF. Okay, now I don't know off the top of my head what it is, so I'm going through the same process and using the PowerOptions tools if I don't know a specific symbol. So I'll just go to the profile real quick, see if we can get a good description. Okay, let's see, it's from Morningstar. Research. Okay, so over here we see that this investment seeks to track the investment results of the Russel 2000 Value Index, which measures the performance of the small cap value sector of the U.S. equity market. So whatever and whoever is determining what is the value sector or the value index of the small caps That's the difference. It's probably looking at less than the full Russell 2000 small cap stocks, or the Russell small cap stocks. It's looking at what are considered the value Russell 2000, whereas IWM is the straight Russell 2000 ETF, which monitors and follows RUT. Okay, David? So that, I think, is the only real difference here. It's whatever they're considering to be the Russell 2000 value. It's a portion. I don't know a significant portion, how big of a portion, but it's a portion of the full Russell 2000. And because those that are considered the value stocks in the Russell 2000 may actually represent the larger margin or the larger holdings of the Russell 2000, it may even mirror the movement of those positions of Russell and IWM percentage-wise. Let's take a look. So we're up 1.2% today on IWN, the Russell Value Index ETF, and IWM was up 1.32. So it's still pretty close, okay, but not necessarily exact. What do I mean? Well, when you look at things such as SPX versus SPY, the percentage gain is usually dead on pretty much the same. Naturally, the monetary gain is different because they're factors of 100 or 1,000 of each other. But in this case, with the Russell up 1.32, I'd assume the RUT was up 1.32 today, and you saw that IWN, as in Nancy, was only up 1.2%. So that the value, quote-unquote value index, so that represents a portion of IWM, what are considered the value positions, I guess, of IWM, but really doesn't go into that as well. Okay, so it's not a full representation of the Russell 2000. It's what's considered the value portion. All right. Now, moving on to Peter. Peter said, this is a bit of a newbie question. What is the easiest way to enter the sale of part rather than all of a position? Transaction history maneuver seems complicated for a simple reduction from 100 shares to 75. Okay. If you have, I believe what Peter's talking about is in the portfolio. So let's see what we have here in our webinar portfolios recently. Do I have anything that's just a stock? What did we open last week? Sam, were we talking about stocks last week, or are we looking at a position? Or was that 2 weeks ago? Oh, good. No, here we go. We've got 3 stocks: Roku, Jobs, JCPenney's. This is from our discussion on November 9th. Okay? All right. So I have 100 shares of JCPenney bought at $275. It's currently at $399, or 45% gain. Oh, that Roku position is doing fantastic too. In any case, now Peter says that when he's following it, what he means is when he's taking it in the portfolio, what is the easiest way to enter the sale of part rather than all? The transaction history maneuver seems complicated. Well, anytime you have an open position, Peter, and you're looking to sell part of it, the transactions view shows me the positions, and I can choose to view the positions such as only those that have been closed and have a realized gain and loss, or those that have an unrealized gain or loss. If it's an open position, I never touch this. You don't touch the transactions or try to edit it here if it's an open position in your portfolio. In this case, all I'd want to do is go to Position Actions, and I know it's scary at first, but just go to Close Position. You're not closing the whole position. It's telling you, okay, so today you're going to sell 100 shares of JCPenney at $399. And I say, no, I'm not. I'm going to close 50 at $399 because I've got about a 47% gain. I want to take some of that off the table. So I'm going to close my 50 at $399. And now I'm left with 50 shares that I did buy at $275. But at the same time, when I look at the analysis or the transactions, I have a realized gain here of 62, and I'm still holding the unrealized gain at 62. I could close for that full 45% gain. But this is closed. Highlighted in red is still open, so I can still track my total gain and loss here, or probably in the transactions menu as well, because I've realized 62 and I have 50 shares. So if you wanted to close 25 shares, you just would have done that to make this a 75 share block. Go into transactions, go to close position, and then you'll be able to adjust the contract size in the portfolio before closing the whole trade. Okay, so that's the easiest way to do that, Peter, as well. Let's see here. I'm just scrolling down. Okay, good. All right. Now, so we've gone there. John's question. Okay, so I hope that answers your question, Peter. Let me know if it doesn't. I know you kind of worry that when you go to position actions and you go to close position there, that you think it's going to close the whole thing. No, just like at your broker, you'll have the opportunity to put in how many contracts you want to close and at what price you're closing it. So you don't have to worry about it closing the whole position without your input. Once you're in that closed position menu, simply edit the number of shares and you're set. All right, we're going to go to the custom spread tool now, I believe. John's question is, I have a position on CYD holding 400 shares. Okay, let's put in what I know so far. With a cost of 10.094. And the present value is 10,744. Or is this? Oh, okay, I'm sorry. So that would be a price of about 5 for 400? Oh, yeah, no, I'm sorry, that's right. 5, I'm sorry. So I'm working the math backwards in my head. I'm sorry. Okay, I'll put in 2502, I think, is about your cost per share to be 10,000. Right now it's worth 10,744. It should be higher than that, shouldn't it, if you have 400 shares? Okay, but anyway, the put you bought is the August 1730 put. All right, so I think you have a cost base about 2502 per share. We're going to put in the 30 put, 2,700 for 4 contracts. Okay, hold on 1 second here. I just got to do the math. I was starting to do it in my head, and I realized I was getting it wrong. So 2,700 cost basis divided by 400 is 675. Okay, so you have 4 contracts here at 675. All right. Could you review the rollout opportunity that PowerOptions suggests? Okay, so let's put this in first. Let me make sure I've got this right. It's 10,008, close to what you've got. And 2,700 is what I showed, 675 for. Married put with a 5.6% risk. The stock is up, but not above the put strike price. I wouldn't do anything with this position right now, but let's go ahead and take a look. Now add to portfolio. Okay, we'll call it John CYD. So what does he mean by rollout opportunities? Well, anytime you're tracking a position in the portfolio, like we just saw with adjusting the position, the number of shares, as you're tracking a position with a portfolio, it'll show you the gain or loss. Now this has moved up 7.4% from when you originally got in, and we can see our total liquidation right now is 1.7%. Did I get that price right? That put seems like it took a large hit. Usually if the stock's up 185, would have only expected a loss of 90, 95 cents, maybe $1 at the most here, not $1.30. So that put declined rapidly, maybe with some volatility change as well. But again, as you're tracking any position in the portfolio, you can go to position actions and then position analysis, anything that's measured as standard strategy, not as a custom spread. Again, here's our position. Okay, and I see a rollout opportunity. And this is discussing income method number 3. Now, you want to know, when you look at the rules in the blueprint for this particular income method, remember, PowerOptions is showing you ideas based on the rules in the blueprint. It doesn't show every income method, but it shows general ideas based on what your stock moved based on the blueprint. But this is a rollout opportunity that's shown. I wouldn't do this right now on the position, except for in 1 or 2 factors, and we'll take a look at it in a minute. Well, what is it saying? We have an August put. You bought an August put because most likely you were expecting a decent, sizable growth on CYD, and you might have expected growth short-term, but also increased growth long-term. And that's why you bought the August put. this adjustment saying that you could close the August 30 put for 520 and buy the February 30 put for 360. It's rolling the put in. It's income method number 3, and it'll take your risk from 5.6% down to 0.6%. You're shortening the time. You've already paid the value into the put, so actually by selling at 520 and buying at 360, you're lowering the total cost basis on the married put by $1.60. So the risk goes from 5.6 to 0.6 for only 28 days of insurance instead of 210 days of insurance. Okay, that's the big trade-off, 5% to shorten the time frame by about 1/10. Now, why would I do this? First, another feature here is you're analyzing even your covered calls or your collars, calendar spreads, and so forth. As you're tracking the position, you can see the rollout opportunities here. It will show you the new return or the new maximum risk. If you're rolling a covered call, adjusting a spread, whatever the rollout opportunity shows. And it's great to see things numerically, but you can also compare them side by side. So I'll go to Simulate Trade, and you see the before and after picture. On the left in red is my original position, current return 1.5%, 1.7% at midpoint, still a risk of 5.6%. By moving the put closer in, you're cutting the cost basis down on the total position by about $160 per contract, or as you see here, it's about $700 for 4. So now the new risk is only 68 cents or 0.6%, and that's shown in blue. Okay, so you've got almost a bulletproof trade for the next 28 days. And we could choose to sell a 27 call and probably erase all of that. But this might not be the best opportunity to do right now. As I mentioned, especially if you think CYD is going to be more of a longer-term growth play and you're planning on holding it to maybe March or April or even May, maybe even further. Does it lower the risk? Yes. Does it allow you to go through the next 28 days with only a 0.6% risk and you could probably bulletproof it by selling a 27 or maybe even a 27.5 call? Absolutely. But you only have 28 days. Okay? You're not going to see any more longer-term growth unless the stock really takes off in the next 28 days. When is this a powerful tool or a powerful income method to use? Darn. Okay, it's unconfirmed, but we see here that the earnings are expected around February 22nd, 6 days after the expiration of rolling to February 16th. Okay, so sometime in this time frame, 220 to maybe 225. It's unconfirmed now. The I almost said sales department, I'm sorry, but investor relations, they haven't released the exact date and time, but based on when their last earnings was, it's going to be somewhere around 222, and they usually go before market. But if I roll to the February 16th and had a 0.6% risk, well, I'm not going to be able to go through earnings with that little protection, okay? I'm going to miss it. It's going to happen after. So maybe, although February is a good one, what the system did is it said, well, there's an income method number 3 possible that could lower the risk down to less than 1%. So it's showing it. But what's taught in the blueprint, you now have to know that I would only do this if I could get it close to bulletproof and go through the earnings. Rolling into February 16th now doesn't make sense unless I really feel something's going to happen in the next 40 days, 38 days or so, that would push the stock higher, much higher, to realize more of that infinite upside profit potential, okay? All right, so in this case now, let's go to the custom spread. Now that I know that, I can look at the important dates here. I'd verify that on PowerOptions. Could I roll to the March 30 put and reduce risk significantly so I'd still go through earnings with much lower than a chance of a 5.6% risk? Nope, I can't, because March isn't available yet. March is going to be available on Monday, right? So we just crossed January expiration. You always have to have 2 months out, so you'll have February and then you'll have March. So what I would tell you is consider evaluating that income method number 3 on your own, rolling into March, that will take you through earnings, and see if you can get less than a 1% risk. You probably won't because you'll be paying more time premium. Could I do it for May, shorten the time frame and lower the risk? Probably. But again, I don't know if that matches your goals, what's talked about in the blueprint, the expectations and your goals. You're shortening the time, and if earnings were coming out on February 3rd, I'd say that income method number 3 is a great play. You're going through earnings with no chance of more than a 0.6% risk, and you still have the unlimited upside in case CYD gaps up to 27, or I should say 28, 29, or 30. That's fantastic. But let's take a look here. What we call the bulletproof vest before earnings. It's usually income method number 3. Here, rolling into May, you're only generating 80 cents. So the risk is still 1.9%. But if we find out the earnings are coming out February 20th, are coming out February 15th, or I'm sorry, February 20th, after the 16th, well, the stock's at 26. Oh, darn it. You have one of these. Is the same thing I had with Planet Fitness and CFG recently. Doesn't offer weeklies, and on a $30, $25 stock, it doesn't offer single or even 250 strikes. So I was going to say, well, maybe we could sell the 27.50 call now and get 40 or 50 cents and get this below maybe 1%. But to get only 20 or 30 cents for the 30 call right now probably isn't worth it. Let's look, but we want it to be higher. Okay, so I roll the put, I take my risk down to 1.9% for May. You still have 119 days out. You'll cross the next earnings with a limited risk of 1.9% from 5.6. And if we assume earnings are coming out after this, you could sell this call for 25 cents. Not going to do much. Yeah, still puts me at 1.1. Not a bad profit and loss chart, but I'd really want to get more for this call than 25 cents, even with your 400 shares and 4 calls. Yeah, I'd want to see that maybe at 40 cents or 50 cents, really get this below 1%, really get this closer to 7. But that's what income method number 3, that's what that rollout was showing you, is shortening the time frame, but you don't want to shorten it too much. You want to shorten the time frame there so that you can get it in there and have the risk, okay? Yeah, the roll would only protect you for 1 month. If you've got a longer term outlook, John, as we were talking about, you might not want to use income method number 3 at all. Even though it's a viable adjustment, even though it could get your risk down to 1% or so, then if you still thought longer term, you wanted to stay in it longer, that's fine. Maybe we could do a different income method heading into earnings, okay? Tell me I didn't delete it. I'm sorry, I'm moving on to Arvin's question now. Arvin, I don't have a tool that does what you're asking. I do it on the fly, and I included, I know what it is, but I use it as a reference. But I included it here in the blog articles for part 1 and part 2 of stock or portfolio insurance. Okay, the equation I use to see how many puts on an ETF or an index I would have to buy. I think I did something really stupid recently. You know how at the beginning of a new year, at the end of an old year, you kind of go through all of your accounts, whether it's actual trading accounts, paper trading accounts, or, you know, clear up your subscriptions and so forth. Well, to continue on with that stock or portfolio insurance, I was doing comparisons and evaluations on certain days in the last 4 months of 2017 on a $500,000 stock portfolio that included 12 or 13 stocks of different prices and different markets to see what was the most effective when we had those market hiccups of 1 or 1.5%, either on NASDAQ or SPX or the market as a whole. Those, you know, in August we saw one, October we saw one, November we saw one, and so forth. And I had it recorded in both portfolios, but on my actual PowerOptions account and my the webinar account here, I think I accidentally deleted that and a whole bunch of other older portfolios we had from previous webinars from 2017 and 2016 even. So I don't have it here. All right, here's Arvin's question. Can you please show how to portfolio hedge if I have 5 stocks? Okay, so the one thing I'm going to mention you first, go to the blog. I know you have before, but just go to the blog later on after the presentation and go through this part here, Part 2, Stock or Portfolio Insurance. And this video here, it's a video I put up, is easier to do. But, you know, how can you protect a portfolio? So if you're expecting, and you're really not asking how to protect the portfolio, what you have to ask yourself first, Arvind, is how much would you lose if there was a 5 or 10% market correction, and then how much of that do you want to protect? Meaning that if I'm in 5 stocks, and we'll show a little quick example of this, but if I'm in 5 stocks, different share costs and so forth on the positions, different numbers of shares and contracts, or different numbers of shares, for example, and I say, okay, well, how can I protect the portfolio? Well, I can't answer that question. You have to tell me how much you want to protect in case of what decline. So assume that SPY, SPX drops 5% in the next week. Assume then that all your stocks fell in conjunction with that 5%, or maybe some of your stocks had a beta of greater than 1, so they might actually drop 6 or 7%. You know, if I have a beta of 1.2, a stock with a beta of 1.2, and I'm expecting a 5% decrease next week, well, then I'd kind of take that 1.2 times 5 to show me that my stock would probably drop 6% or 6.5%. Okay? So what would your total portfolio value be if 4 of your stocks dropped 5% and 1 dropped 6%? What would the total monetary loss be on the portfolio? Now you can ask me, my portfolio would drop $8,000, or okay, roughly we could say 6% of the total portfolio value, but let's say it falls $8,000 and I want to protect half of that. Well, the rest of this presentation here shows the math, the simple equation that you can use to say, okay, I want to protect $4,000. What puts and how many contracts of an SPY put would I need to buy to hedge a $4,000 loss? Okay, and I also show you what tools on PowerOptions to use that. Excuse me. So let's go back here. Now let's just take SPY. And actually, I think I want to use the other tool here, but let's say this. SPY here is trading at 280.41. All right. So in essence, I'm expecting a 5% decrease next week. Whoop, sorry, at 280. 280. Right, $1.40. All right, $14. So what would happen if SPY dropped down $14 to $266? Yeah, $266 next week. Okay. In either, I got to go to another strategy, I apologize. In either the long call or the long put, is kind of how I base it. But first, I want to, I want to go to the long option finder, and I'll just use SPY, okay? $266, and I'm just going to put in $500. My expected date, I said next week, so yeah, let's put it on the 26th or the 27th, okay? Now what this tool does is it's going to go out and it's going to show me which puts would give me the highest return if the stock hit my target price and my target date. This is one way to do it. There's another way too. But really what I'm trying to see is how many puts would I need to buy? Oh, and you're saying, yeah, Arvind, you're saying 300,000, you're saying 5. Yeah, that's what I'm saying, is that you can do that math later. But right now I'm seeing that the 271 put with a price of 22, now I could buy 22 contracts if I invested $500, and this would get me back 11,000. Okay, so that seems a bit extreme. But what I'm trying to look for here is that how many contracts would I need to buy? I could go to the profit and loss chart. The webinar explains this much better because I had it planned out and I walked through it. But what do I need? I need to hedge this bet. There's a one contract that's showing me 22 cents. So I'm going to assume 40. Nah, yeah, let's say 40 contracts here. Why 40? Well, let me show you. So let's say we bought 40 contracts at 22 cents. I pay $860. And this is for a 31st of January expiration. Okay, it's probably a quarterly actually. But let's go to 266 and say, okay, so next week on the 26th, SPY falls to, okay, so that's way too much. I don't need that many. See, I'd get $19,000 back. Okay, so again, assuming I would lose 8,000, if with a 5% decrease, again, I want to hedge 8,000, so let me just take this down to about 18 contracts. The formula is described in the webinar again. I think it's in one of the blogs too. Whoops. Oh, yeah. So now, yeah, so there it is. It's about, I'd need to buy, in our situation, not your numerics, you mentioned a $300,000 portfolio. But see, what I would need to do is maybe buy 17 or 18 contracts. And why did I use that long option finder first? Is because that one shows me which option would result in the highest percentage return if the stock hit ETF hit 266, 14-point drop or 5%. So here we see the cost of 18 puts at 22 cents of that 271 strike would be $387. And theoretically, if the stock was trading at 266 next Friday, I keep saying stock, I'm sorry, the ETF was trading at 266 on January 26th, the value, this would go up to $9,000, and I'd have a value of $8,500. Oh, I doubled it. I'm sorry. So this would have protected against the full $8,000 loss with a 5% decrease as well. Okay. And no, I'm showing you there's more follow-up to this, Arvind, and that's going to be coming out very soon. But I understand your question, and you're saying, so another question then is I don't have to buy individual stock puts. I can buy puts on SPY. Not really. Okay, what I'm showing is that you can hedge a portfolio using ETFs. So if investors have a covered call portfolio or even a credit spread, bull put credits or bear call credits, you can't buy a put on each one of those individual bull put spreads because number one, that'll change the whole dynamic of the spread. You're no longer in a bull put credit, you're in some kind of ratio spread. So a better way to protect or hedge against that kind of portfolio is maybe puts on a broad-based index, puts on the ETF, which are less expensive but still give you the right percentage return, maybe buying calls on the VIX. Right? That's what's discussed in those two blogs so far is the three to do it. Now we're going to get into later on the actual cost of doing that and why it's not effective unless you're very good at market timing. In other words, if I'm buying SPY puts and I expected the decline to come somewhere in August because I thought the market was overbought, well, that means I bought multiple contracts of SPY puts for September expiration, then October, then November, then December, and then January. I've put too much money into insurance while the market goes up. And a couple weeks ago, I can't remember if you were with us, Arvind, but a couple of weeks ago, before the Friday webinar, I had a coaching session with a gentleman who had long stock positions, several stock positions, and he'd hedged his portfolio with QQQ. A lot of his were tech stocks, Apple, some of the FANG stocks too, and things of that nature. But he figured that he had, I'm going to say this, the customer did it wrong. Okay, so he figured that he had 7 or 8 tech stocks, the FANG stocks and a couple of others, and he had 2 Dow stocks and he had 3 sort of S&P 500 stocks. Okay, and what he didn't take into account is that sure, he had 8 tech stocks, but the majority of his portfolio was invested in a single stock that was not a tech stock. So he looked at the sheer number of the symbols. He didn't look at the contract size and the investment size, and he had inherited or got a lot of this from a family member, or I think a family member passing. So he bought puts on NDX 3-month out puts. He did this in September, October. He bought 3-month out puts for, not NDX, QQQ for the techs, and lost all the money in the puts. he lost all of the money on the puts, and he lost money on his portfolio at the same time. You say, how is that possible? Because the stock he was most invested in over that 3-month period in his account was GE. So from 24 down to 23.50, 23.25, I think it was, down to 16, that monetary amount represented 45% of his portfolio, or 45% of his allocation, his monetary allocation. The other 55% was in 9 different positions, 7 of which were tech stocks. So we protected it with the NASDAQ out in September with QQQ. And what happened to QQQ from September forward? Well, of course, with a couple hiccups we saw here and there, and a big one in the beginning of December, that. So all the puts expired worthless. His other stocks moved up, but not as much as 45% of his portfolio had moved down. That's the risk of trying to protect a stock portfolio with SPY puts, IWM puts, QQQ puts, even if your portfolio is mostly made of those, is that sometimes 2 or 3 of your stocks can hit a bad patch. Here we are at earnings. Here we are in earnings season. Over the next month, you might have several stocks in your portfolio that drop because of poor earnings, but NASDAQ keeps going up. That's the risk of not insuring the stock. So when I think of insuring the stocks, I know it's more expensive up front. I insure the stocks 1-to-1 with a put. You've all heard me say that over and over again. That will be included in the comparison that's coming out soon. I've got 6 other projects going on at the same time, so we'll get that done for everyone there. But check out the blog, watch that video on part 2, stock or portfolio insurance, and that'll give you the rundown of that calculation. Okay. Ben's been very patient here. You all have been very patient. We still got about, it looks like 8 more questions to go through. Ben says, Mike, I sold a cash secured position will be assigned this weekend. Should I do a ratio call spread? Ben, I'd need to know more specifics and on that, because it's a good idea, but there might be other ideas. Ben, I want to ask you a question personally. Have you watched the webinar here, the free webinars? Remember, at any time you can access our webinars, powerop.com/webinars.asp. Oh, sorry, folks. Let me get there. Okay, so that's just linked, powerop.com/webinars.asp. Options concepts. Manage your broken position. This talks about alternative methods for managing a stock position that's fallen in price, or a covered call position that's moved against you, or managing a sold put that is ITM or the stock has been put to you at a lower price. Stock repair might be a good idea. If you don't see a stock repair, you might have to average down or consider, I'm not going to say you have to, you might consider averaging down first and then going into that position, okay? Oh, so you did watch that. Good, good. And Sam's got a good comment. Sam's got good comments here as well. Okay, so you've got some numbers for me. Oh, I don't want to go here. Let's go to, it's TNA. Stock repair. 78.60. I'm just going to put in 100 to keep the math simple, Ben. Oh, no. You bought TNA with a total cost base, I'm assuming, of 78.60, even if you got put at 80, but you had generated premium, so your cost base, I'm assuming, is 78.60. The stock's at 78.65. I don't think you should do a repair now. In fact, none of them are showing up. Ratio call spread might work, but I wouldn't do a repair in this situation. Maybe just sell a 79 call if you're worried about premium or the market falling. Or now create a collar. You're below the cost basis of the stock. I'm sorry, you're below the stock price. You've got a 5-cent profit. You don't need to repair it. You might not have the profit that you want, but you're still at a gain. Okay, so take this a different way. You're not losing on this position yet, is what I'm seeing. So maybe use the custom spread tool and just evaluate a collar on TNA. If you're worried about going forward for the next week, of course, you can't do it on Monday. And a lot of comments, several comments appeared here with the threat of the shutdown looming and other things going on in the market, but mainly that's the big issue. Unfortunately, you can't do this to Monday, and if there is a market hit to that, we might see it on Monday before any of us can trade. We know that happens. But on TNA, going out, You've got a cost basis of 78.60. Put that in there. Buy 100, again, 78.60. If you want to give yourself some upside room, oh, these look pretty good. So I'll go 80. I'll sell the 80 call for probably about $1.60 midpoint. I'm going to go, man, that is expensive, but let's go with a 75 put. Let's mix this up. So just to keep the math simple, 5-point spread. Mike, why don't you put in the right ones? So you sell the call, you buy the put and a collar. There we go. Yeah, so you generate some income here, a little bit of premium, about 40 cents per share, but the max risk is only 4% if the stock falls below 75. Then, if it does fall below 75 and you get out of the position, or you close the put and let the call expire, then you could do a ratio spread. Then you could do the stock repair if you still think it's going to recover. But right now, you could make a 2.2% return if the stock goes above 80, $176 profit, not great, but you only have a 4% risk on the position. That's one way to look at it because you're right essentially at the current price, okay? Do a ratio call spread and buy a put? No, see, I'm not talking about a married put here at all. Okay, I'm not talking about a married put. I'm talking about a straightforward collar because right now the stock's at 78.65, so this is just like you went out and bought the stock today at 78.60, and it's up 5 cents from when you bought it. Now, do you consider holding this long term? A 3 times ETF, to me, when I see a 3 times ETF, I don't consider someone doing a radioactive trade or a married put for growth on that. I think that's more of a, to me, that seems more of like a short-term play for income generation and speculation. I mean, the income is great, but you know this is going to swing more wildly than anything else, right? It's going to move more quickly because it is a 3 times. That gives you the volatility for some of the decent premiums. Would I do a ratio spread with this? Sure, you could get further upside, but it has to work. And you won't be able to cover the cost of the put if you do the ratio spread. So what would I do in this scenario? Well, I bought the 75 put. I'm going to leave that in play, not as a married put, just as a collar. But if you want some further upside, all right, maybe buy the 78.50 and sell 2 80s? Ugh. Well, buy 1, sell 2. This will give you a little bit more upside, but you're not going to receive as much credit. Okay, you're going to get 205. Yeah, you're going to get 30 cents of credit, and you know you have that little jump and then the infinite upside. So buy. Forgot to sell. I'm sorry, I forgot to sell 2. My apologies. That's not right. Okay, so in this scenario, you increase your risk from 4.4 to 5.7 if the stock's below 75. And the max risk only goes up to 2.6% from 2.2. All right, so that's what you have to decide. Is that worth it for you? I'm not trying to sound condescending, Vin. I'm sorry. I'm saying, is the increase of 0.4%, or about 30 cents from 176 from just the collar that was at 2.2, is that worth it for the extra 2 commissions to buy the call and then sell 2 here for this particular trade? And receiving an upfront credit of only 30 cents, because you're getting to, I'm sorry, it's more closer to 40, 35 cents, let's call it. Okay. Again, you're increasing the risk by 1.3% because you're receiving less premium, and you're only gaining 0.4% in extra return by doing the ratio call spread. Now, true, you could look for different combinations, but remember, you still want one where selling 2 of these, 210, is higher than the cost of buying 1 of those. So you usually have to be right around at the money, as I showed, just a little bit out of the money with the 80, at the money with 78.50. You could maybe do the 79.50, but then remember, you're only getting $1 back between the strikes. Okay. Does it give you a little bit more benefit if the stock moves up as you expected? Yeah, it does. But at the same time, there's a trade-off. Okay. All right, let's see. I'm sorry here. Let's scroll down. Might do Rajiv's question at the end. It looks like he left, but he might have come back in. I'll get to that in just a moment. Where is, I got Sam's comments here. I'm going to get to all of those in a moment, but I want to get to Chris, okay? Okay, let's take a look at MO here on the chart. That'll help us out here for Chris's question. Comments. So, here we go. Altria, MO. And we're gonna go ahead and put in, whoa, strange dip. Let's go 6 months just to start with. Bollinger Bands, MACD. All right, just setting this up basically so I can see it here. I'm going to store the settings this time so that if I do come back here, we can see it again. All right. So anyway, what Chris is mentioning is that he had been doing since November 1st, 2017. He's done 5 MO 6250 right about here. 60 bear put spreads. Okay, but MO went up and now it is at 71. I thought maybe it could not be a bad idea to give the spread more time and roll the whole thing up and out to something like the February 2nd, 71.5, 73. So up in here. You know, we've pulled down, it's hit the bottom Bollinger Band, it's starting to come back up and just crossed the 20-day moving average, and the MACD looks like it's about to cross as well. Depending on what happens this weekend, it'll be interesting to see. It might continue the trend. I see a trend that's starting to go up. It needs to give me a secondary significance here. I need to see that crossover, and then I think this would be going up, not based on the outside market features, okay? Okay, so you tried to roll it, but it didn't get filled, and this happens with MO, which is pretty liquid. Isn't it? Yeah, it's a pretty liquid entity. You know, the February 2nd, 71.5, 73 didn't get filled at the prices that you want. Okay, so I'm just looking at the chart here. We're doing bear puts, debits. Now we're talking about rolling it out further in time to February 2nd, about 14 days out. At the strikes here, I mentioned 71.5 and 73, but you didn't get filled. Well, I don't know what you tried to put in at midpoint. Let's just take a look there at MO's chain. And there is an issue too that might need a looking at. Let me erase all drawings. We're on the small chain. Let's go to February 2nd. And we're talking about bear puts. So I'm just going to go to the put only chain. Okay. 71.50, 153, 176, 23-cent bid-ask spread. I probably would have put my bid here, midpoint, maybe at probably 160. I don't think I'd go to 164 or 163. That's 10 cents up. Maybe 163 potentially would have been my midpoint there. And then the 73, this is where it's hurting. It's an 80-cent, close to an 80-cent bid-ask spread. So if I try to go midpoint, about 230 or so, I probably would not have gotten filled on this. Or I'm sorry, 240 almost. Yeah, 240. My apologies. So I probably would have tried this at maybe 233, 235. So I would have paid a debit, it looks like, of about 73 cents, 74 cents. That probably would have been my entry, is about 73 cents at midpoint. Okay. Is it liquid? Yeah, let's get it selected here so we can see what we're talking about. All right, so let's go to choose columns here and add in and go ahead previous and current option volume and open interest. Pretty sure these are liquid. So for our strikes here, let me clear out those drawings, highlight some things. Oh, wow, I was wrong. No previous volume, no current volume, and only one open interest. That seems really low, even for a weekly with 14 days out on MO. Let's take a look at some on the next side. I mean, these, yeah, what I'm seeing is no previous and no current option volume and only one open interest on these legs. Highest open interest, of course, is down here. A lot of interest in selling or speculating on a drop in price or part of a spread. 20 contracts in 18, 21 here at the 72. Yeah, those two that you selected are pretty low, but then a lot of them are. You know, a lot of them on that range are as well. Let's look at the calls real quick for the same expiration. Just curious. Yeah, see, everyone's loving the calls here on Altria. More open interest, more volume, 3 strikes in, 3 strikes down. Okay, so the puts aren't showing a lot of activity on Altria. I'm not going to say that's a buy or sell recommendation, but those puts there, that just had 0 activity and very little open interest, if any. So that's what we were looking at. Oh, I'm sorry, I did want to follow up on this. So that was probably part of the problem, and that's why the bid-ask spread was so wide. I mean, look at the calls. The in-the-money calls, 30 cents. Okay, here we're at 70 cents. Here we're at 40 cents. Here we're at 40 cents. There's not one of them that's near that 80 cents we saw for the put. Okay, so these bid-ask spreads are tighter because there's much more constant activity and open interest as opposed to what we saw in the puts, which was 001. All right, so the call side has more going on than that. Maybe it could have gotten a better fill on the bear call. 71.50 strike to 73. Much more activity, current volume, open interest. It's not a bad idea to always compare the parity trade. Even though you're interested in the debit for the risk-reward tolerance you like, I may have compared it to the bear call with those strikes, seeing that there's activity and volume and lower bid-ask spreads on the bear call side as opposed to the bull put. Sorry, bear put. The bear put debit. My apologies. All right. What I was going to say, when we were talking about the ETFs to protect a spread portfolio or an options leverage portfolio, Sam did chime in, and Sam's got comments I was going to get to earlier too, but he said that he did the same last year. He bought puts for TQQQ and UDOW. At the same time, he actively trades UVXY. We've talked about that in many webinars, or we've mentioned his UVXY positions and trades many webinars. He had puts all year plus owned SPY at 211, so he didn't lose much overall. And the portfolio was going up with the puts and SPY going down, and then he was selling against them. So he wasn't just treating, and that's the difference from what Sam's approach is, and it's not much of a difference. But the difference is when Sam buys puts, for example, on those positions for the portfolio, in that sense, is that he treats the puts that he bought as an actual trade, an elite point, or a starting point, I should say, for doing other positions. So he might convert that insurance he bought as part of the portfolio insurance as a separate trade where he's going to manage it by selling against it or buying more against it depending on the upswings up and down. So he's going to turn it into a vertical spread or a calendar spread at one point or another, but keep the insurance on the portfolio in place with UVXY, TQQQ, UDOW, and so forth. Okay. Sam had also mentioned, I haven't looked at this stock in a while. I don't even know where it is. I was actually interested in it a while ago. At 94.99, Sam said that he did the bought 95 and sold 105 calls for debit spreads. So he did a bull call debit for earnings for Jack in the Box. And he also did the 85-80 puts. So it looks like you kind of got a calendar going on there, sort of a debit calendar, I guess, or no, double dip. I'm sorry, you're double dipping bull. I'm sorry, it's a bull call debit spread 95-105, and then a bull put 85-80 for the earnings play, I think. That's how I'm reading what you wrote in there. I might be wrong. You might have done that sort of a condor, as I mentioned, but it's for February expiration for earnings, and that's an important thing to keep in mind too. And I forgot to mention that when we were looking at the other position there, when we were evaluating the ratio call spread on. Oh no, we didn't. I'm sorry. It was just because of 3 times ETF. I was going to say I'd look at earnings. On the situation Ben was talking about, where the stock was put to him, should he do a ratio call spread? I was going to say first we should look to see where earnings are, as we did before, but it's a 3 times ETF. We don't have to worry about that. All right. Rajiv's question was, on a collar trade, if I have a stock in my trading account and bought twice the puts for 6 months in the future and sell the future out of the money calls for 18 months in the future, I just moved to OTM. Oh, okay. So Rajiv is saying this. We've talked about this in other webinars, and I know that doesn't mean anything to all of you now because many of you probably didn't see that. So this is a trade I'm not a fan of. And there are ways to manage it, and someone teaches it this way. But what he's saying, instead of doing a collar that we looked at before, Rajiv wants to do a credit timed collar, a calendar collar that's reversed. I know terminology gets weird at this point. So anyway, let's say we did AMAT right about 57.50. And what he's going to do is buy twice the 6 months out, July, at the money. So I'll buy 6 month out, 2 of the 57.50 puts. But then what he wants to do is sell out of the money calls 18 months into the future. Now, I can't do 18. I don't want to go to 2020. We're just going to go year out. So we're going to sell maybe 60 calls. Does that give me what I want? So 5, 10. Actually, let me change this. I'm going to buy 2 of the 55s, okay? I'm going to have 100 shares of stock at 57.50. I'm going to buy 2 of the July 55s, and I think we're only going to sell 1 of the January 60s, but he might be selling 2. Well, I'm going to look at it as 2 first. This is what I call a reverse collar. But he's doing it a ratio anyway. But you're buying puts that are closer in and selling calls that are further out, and the idea is to try to get it done at a credit, right? So here I sold twice as many, so I'm getting 693. I would have paid 795, but if I sold 2 to 2, I get this, and we get this sort of check mark profit and loss chart at the first near-term expiration. I'm not a fan of this, and the way that I see it taught, and we did a comparison on one of the webinars recently that we archived back in September or October. It's recorded, it's on YouTube, and I think it's on PowerOptions. But what some investors do, they'll buy 100 shares of stock. I forget who teaches this, and then they'll buy one, let's say, July put at the money, so 1 July put, and then we'll sell 1 January put further out. Or sometimes you're buying a 2-month out put and selling a 6-month out call, however it works out. And it gives you this check mark profit and loss chart. And the idea is, well, the risk is the same, but you could only realize this maximum risk if the stock's trading right at that point at expiration. No. This is not expiration of the call. This is expiration of the put, the shorter term expiration. So what happens if we reach July and the stock's still trading at that price? This put expires worthless. My 60 call is still, in this case, 8 months out in time. So I haven't seen a lot of time decay yet. I've seen some, but the most amount of time decay is not going to start until the last 60 to 90 days. But I would have seen some decay here, but I'm still going to be at a loss because of this $6.93 you collected, you might only have $2 of time decay. It would still cost you $4.95 or $4.90 to buy it back, and you just lost $4 on the put that expired worthless. Assuming the stock's still around 56 or 57. Now, to stay in the position longer term, because you're still underwater, what do you got to do? I've got to buy another 55 put, maybe out to October, for another $4, which does what? Increases the cost, increases the risk. Still have infinite upside profit, but no, I don't, right? Because that's still capped at 60. It shows infinite because it's based on the short-term expiration. But as we get these to equal, I'd have to dump more money in for the insurance to stay in the position. That's what happens. I don't like the reverse collar trade. But your question was, what could you do with one of these if the stock price moved OTM before the strike price? The stock price the stock price doesn't move out of the money or in the money. It depends. What do you mean by the call out of the money or the put? And that's what I can't tell. If the stock went above 60 before expiration, what do? Well, you watch your put expire worthless, and then you have to manage the call. If the stock falls below 55, what happens? Well, you've got a gain on your put, and you've got a capped loss here because you set up a collar sort of. You'll have some decay in this call, but not much. This is why I don't like this trade. It goes against the opposite of the basic concepts of options trading, not radioactive trading, of options trading, meaning when I'm selling premium, I typically want to sell shorter term. I want to sell month by month or week by week to annualize, to maximize my annualized profit. The option that's 6 months out in time is not 6 times the cost or 6 times the value of the near-term options. So when I'm selling premium, I want to be selling closer in. When I'm buying premium, or buying insurance, the option that's 6 months out is not 6 times the cost. So it's better cost per day, higher up front, but it's better cost today to buy further out and sell closer in. Now, what is the problem? One of the problems that everyone has with the radioactive trading that I advocate and I do in my personal account, or even standard collars compared to a covered call. The put's too expensive. I'm going to give up all my profits for the cost of the put. So someone comes out and says, hey, instead of buying a put that's 6 months out and trying to find a call near term that's only 1/3 of the price you paid for the put, why don't we sell a 6 month out just out of the money call and buy a 2 month out at the money or out of the money put. So you reverse the idea. Instead of buying a put far out and paying less per day and selling closer in and getting a higher average annualized return if you can sell month by month, why don't we sell far out and get $4? And why don't we pay only $3 to buy closer in for the insurance? You're still getting a 110 premium on the position, right? So they're reversing it. And then again, at near expiration, the March expiration, you get this check mark profit and loss chart. I call it a reverse collar. I don't know what they call it. I call it a reverse collar. You could also call a reverse collar by changing the call and the put strikes to where the put is above the call strike instead of below it. You can name these things any way you want. And that's the problem I have sometimes with these open discussions. Okay, why don't I like this? Because in the first 30 to 40 days, the March option that I selected, I'm at a loss between $50 and $62.94. That's my upper and lower break even, not at the end of the trade, but just in this 30 to 45 day time period. Whereas the stock currently trading at $57.40, assuming no earnings, no change in the market, no change in volatility, which things can happen, what is the most likely place the stock will be trading 95% of the time in the next 45 days? I'd say it's between 50 and 62. 90% of the time, normal market conditions, 45 days, even with a good uptrend, the stock's probably going to be in this area. That's all loss. How is that helping my position? Okay, so you hold it to the first expiration. Let's go to March expiration and say the stock is in our loss range at $57.40. Okay, what happens? Our put goes to 0, that we know. That July call, stock stayed at the same price and we hit 45 days or so to expiration. We should have lost a reasonable portion, 1/3 of the time value. You sold a call for $437. The theoretical value of that July 60 call is still at $339. You've only gained $98. You destroyed everything you bought for that put and have no value left in it because you bought shorter term, didn't really buy in the money, stock stagnated, you lost all of that and only gained $100 in time decay in the first 45 days. So you're at a loss of $219. Now what are you left with? Let's clear this out. Oh, shoot. Sorry about that. Got to add the July 60 call back in. Sorry, folks. Sell that there. Get that done. All right, so there's our check mark again. Now, March expiration. What happened to that cost $318? I got to dump it back into the stock. I lost all of that on the put. So now my total cost on the stock is $60.68. And I've got a 60 call sold at $438. What am I left with? A covered call with a stock trading at $57.50 for a 6.6% return to July. Well, I don't want to be in this position. I was told this was a no-risk trade. So what do I have to do now to keep protecting the position? Now I've got to buy, we're in March, April, May, June. Okay, so I'd probably buy maybe a May, maybe a June, but let's say I had to do it. I have to buy a July. We'll go 57.5 put again, and we'll put in the original cost we had of $318. So now I've paid $6.36 total on insurance, collected $438 on the position. I'm in a collar where the maximum return is 0.9%. Sure, I could only lose 3.3% to begin with. That's probably not the way they teach to manage it. That's what I see, because eventually that put expires first, or you have to manage or close the put, and then what? If you want to stay in the position, you have to buy more. because you sold that call 6 months or 8 months out in time, in the first 2 or 3 months, you haven't seen the time decay you expected to be able to buy it back cheaply. So you got to stay in the position. Are you going to stay in a covered call? No, the whole reason you were trying to do this new idea is to have a low risk. Well, so now what do you got to do? Now you got to buy another put, eats your returns, 0.9%. Okay, you're in a collar with a 0.9% max and 3.3%. I don't like the approach, personally. I know there's more to it, and they probably have neat ways to manage it, just like we have neat ways to manage a straightforward radioactive trade. And I'm not saying the person that is teaching it and is advocating this sort of reverse collar is selling something that's bad for investors, depending on how he manages it, what the other triggers that they're using. I'm not saying that he's teaching it wrong. I'm saying I don't like it. I'm saying because each way I look at to manage that position doesn't make sense to me, and I think I'd do better if I was neutral to bullish long term without worrying about having to sell that position on it. That's what I don't like about that. Okay? All right, let's see here. Let's see, okay, so Sam says he needs to work out the PPD so he'll know how much time decay is coming to compare the put decay price and see where he's making money and losing on his capital. Absolutely. Yeah, I agree. And then we did kind of show that, Sam, but you had mentioned it before I was going in there as well. Okay, Rajiv, you did say earnings is coming. Can I use a bear put spread on Netflix? It may go down after earnings. Well, sure, you can do any spread you want to. Just be aware of the risks. 195, 220 bear put spread on Netflix before earnings, sure. I mean, you could do that. I'm not going to say it's positive or negative. You know your risk up front. You're just going to have to practice proper position sizing and assume that if you're wrong and you take the full loss on any directional vertical spread for any strategy at any time. So a bear put debit, I'd sell and buy. You're planning on the stock going down. You know, so you're doing one of these leverage ones where you're trying to get a 786 cost on a 25-point spread, so you're looking at a very high potential return if you're right, and if you're wrong, you lose 786. Again, as I always say, sure, you can do this. It's more aggressive than something that I would do. I don't play directional plays on earnings, meaning I don't do vertical spreads in this fashion around earnings. I do straddles and strangles, buying straddles and strangles. You know, I've mentioned that before. So what's the risk here? The risk is it does the opposite and goes up, and you lose everything you invested into this right away. No ifs, ands, or buts. Gone. Sam says he's not touching Netflix at all for earnings or for anything else right now. And so that's the, you know, that's what I'm looking at here. If it jumps up, then you get crossed out there on that position, okay? Right away, because all the implied volatility would drop down. You'd have the volatility crush. You wouldn't be able to manage it as well. Let's just look at Sam's comment earlier on the AMAT one. Okay, so that's what I'm saying there. And if it does go down, yeah, you're right. And you're a 200% return because you're trying to use an out-of-the-money bear put debit spread to lower the cost of the debit and look for that higher return on the 25-point spread. If you're right, you're right. If you're wrong, you lose 100% of what you invested in an instant, because these implied volatilities will collapse. These positions won't be worth much of anything at that time, okay, depending on how close you go. And if you go right at earnings with the expiration, so it's on 122. So if you took the 126 earnings, I'm sorry, for next week, for Friday, you have the Friday positions. It doesn't go the direction it goes up, even if it stagnates, even if it moves up 2% and goes to 222, for example, or 221. 224. The implied volatility on those two options would collapse, and with 3 days left, those premiums are going to drop significantly, so you're probably going to realize a lot more of that 786 loss than you anticipated if it doesn't go in the desired direction. You could be right, but I don't play vertical spreads as directional plays. Okay, Sam, I missed the other comment there, but you had a range there. And he's talking, okay, so Sam also mentions he's doing ratios on UVXY, back ratios on UVXY and BBY for today's expiration, and he protected that position with an extra call. Sam just commenting he's still in the riot position. Okay, and Boeing. Oh, I've had a lot of amazing questions on BA today. Oh, sorry, this week on Boeing on BA. A lot of people with calls. We had a comment last week on it as well. But I had a gentleman who had what was it, a 330? No, I'm sorry. No, sorry. It was a 300 call that I think he had purchased. It was a 300 call. I can't remember for March or April. A 300 call that I think he paid about $40 for, and he had almost a 50% profit in it when the stock was around 340 because it retained most of its time value as well. That's also, Rajiv, you got disconnected and then you came back in, okay? And Rajiv, real quick, you say another position in Ford Motor. Okay, they increased their yield, I believe, recently. Ford will be assigned to me. Can you open the March debit call, buy a 12 call, and sell 13? Sure. Again, I mean, I'm not a mentor. I'm not your mentor here, and I'm not your options trading guru. You could open that March call, but just as we talked about, 12 and 13, this is one of your midpoint debit spreads. What do I mean by that? Well, you're going to buy one and sell one. And what I mean by midpoint, and there's nothing wrong with this, Rajiv. In fact, if I open a bull call debit spread that is more than 20 days out in time, this one seems a little shy to me. I might be more tempted to buy the 11 and sell the 13, although that would be expensive. I like it to be right in the middle. But you see what Rajiv is doing. He's trying to get a slightly lower cost on the debit. He's treating it as a long call, but if it does go above 13, he'll have a 300% profit. But even if it just goes up to 1250 by February, mid-February, he can probably close out the 12 for a reasonable profit, 60 cents or so, or sell it for 60, so he doubled his money there, and this still might only cost 8 or 9 cents to buy to close. So again, what is the difference of doing this bull call debit versus doing an at-the-money 12, selling the 12 and buying the 11, so I would go down here, wouldn't it? Or by doing the 11 and buying the 10. Okay, well the difference is as you go lower, as you go in the money with your debit spreads, you have a higher debit, higher cost, which is equal to a lower monetary and percentage return. So why would you do it? Because you have a higher probability of getting that lower return. So maybe 7 times out of 10, 8 times out of 10, you make this return. Maybe 5 times out of 10 or 6 times out of 10, 5 or 6 times out of 10, you make the middle return, the at the money, where the stock stays above 12, and you make the full profit. So yeah, maybe 6 or 7, but more like 5 or 6. When you're doing an out of the money spread, as Rajiv's talking about, which is a little bit more aggressive, you might get a 300% return. But you might be right only 3 or 4 times out of 10. You get that. The other times you lose 100% of what you invested. So it's all a balance game, right? Higher probability, lower return, more conservative, in the money, bull call debit spreads. At the money, 50-50 shot, really good reasonable return, probably of 100, 120%. So looking to make maybe 60 cents with a debit of 40 or 50 cents to 50. Okay, and on the in the money, this would be reversed. You'd be paying 75 to make 25, but have an 80% probability of getting it. Now, out of the money, you're spending a low cost 25 for a hope to make 75, but you might be right only 3 times, 4 times out of 10. That's the trade-off. So, can you do this? Sure. I don't see why not. You can do it, but just remember, what do I always say? Make sure whatever your cost is that you practice proper position sizing. You don't overtrade because it's a lower net debit. Yes, you could be looking really good, but remember you have a higher probability of losing 100% of your trade as well. Of course, it may recover. Yeah, that is very possible as well. Okay. All right. Oh, Ben, earlier, I'm sorry, I had missed your comment. You had asked to do a 2-week out income method number 5. Yeah, you can test that out on PowerOptions and see if you can get the net credit you want with that ratio call repair. TNA, was it? 78.60, I think, was our idea. We'll go back to bins real quick here. A 78.60 cost basis, TNA. And 2 weeks out, 14 days. I was doing January 26th. So ratio call spread here, 78 is at 1. Look at that bid ask, 153 to 284. So we're at $1.30 or 65 cents. So that would be maybe 210, 215. It was 78.79. Might give me something. Let's try it. Whoops. Hate it when I click the wrong one. 78.79 ratio spread. Buy 1, sell 2. Midpoint, do we get a credit? 218, 358. Now that's just the ratio call spread, okay, to get you that higher point if the stock was up. But remember, look, I'm just barely in the money on the 78 strike. That's not bad. This gives you an extra oomph. Still only 3.6%. But now to be protected, remember, because you only collected a $1.40 net credit, which is good. $1.40 is good. But on the 14 days now, oh, at midpoint, I've got to go to the, I said the 75, but at midpoint, I'd have to go to the 76 there. I could go below midpoint, but let's try that. No, it's 280. Nope, I'm sorry. I was thinking 140 times 2. I'm sorry. Silly move. Silly, silly, silly move. This is my 140 to 75, as I mentioned, and it's close to 140. Yeah, so there, we're still around the same thing that we saw before, aren't we? Remember we did that ratio call spread for 1 week out with smaller premiums. Oh, that was a collar. But that collar we were looking at was a 2.2% max profit with a 4.4% gain. I'm sorry, with a risk of about, what's that, 2.2 to 4.6. Going 2 weeks out might make 1.9%, but at 4.4. Or that's a standard collar versus this one. So did you gain anything more to the upside? Actually, not much. And you're still keeping about the same risk as well. Okay. Yeah, Sam and I feel the same way on those debit spreads, whether they're out of the money, in the money, or at the money. You know, only trade 2% of your account. Have a strict plan to exit and cut your losses and try to let the winners run. Yeah, only risk 2% of your account or so in each one of those positions. I'm not saying this is a bad trade, Ben, but again, do I think it's necessary for you to do the stock repair, the ratio spread on this position, whether you add a 6-month output or a near-term put? I don't know. I think the collar is still a better approach because you're getting more premium and you're right at the cost basis. If your cost basis now, why would this change? If your cost basis was $79.40 or $79.50, for example, with a stock at $78.65, this, I think, is a decent repair. Why? Because even though it only goes to 0.8% and I still have 5.5%, your cost basis at $79.50, what the ratio repair did is it gets you back to break even at only $78.69, only 4 or 5 cents above where the stock is right now and 90 cents below, 80 cents below your cost basis. So that's the power of the ratio spread. If you have a cost basis of $79.50, $1, $2, maybe even $3 below where above where the stock is trading right now, that's when this ratio call spread comes into play. Okay, that's when it's really beneficial because as you can see, even though my cost basis, I put it up to $79.50 at a bigger loss. Let's say I sold the 80 put for 50 cents and I got put today at 79 and my cost base is $79.50, but the stock has dropped down to $78.65. The ratio repair, actually the ratio repair would repair more if I didn't buy the put. That break even would be lower, but here we can see the break even now is not $79.50. We're at $78.69 for the break even. It's only 5 cents away from where we were, even though we're still 80 cents or so, 85 cents or so below, the stock's 85% below our cost basis. That's when this ratio spread is really powerful. And it is really powerful. I just don't tend to do it when I'm right at the cost basis. And the reason why, again, is because I may just want to sell a call to maximize the premium rather than try to mess around with the ratio spread in that case. Okay. Well, I think that got all the questions that came in. I don't think I missed a question. If I did miss a question, I do sincerely apologize. We're 5 minutes after 6 p.m. Eastern time here. So I just want to say if anyone has any last minute questions, you can go ahead and send those in. Yeah, Sam says Bitcoin lost so much value, 50%. That's why he was looking at SQ and Riot, Square and Riot, playing the stocks that offer the services, or opposite. Square SQ was up $2 with that as well. So yeah, that's the reason he has been looking at those. And I forgot about your Roku position that you did a few months ago until I looked at the portfolio and saw that, and I completely forgot that I meant to actually look deeper into that back in October, November, and I completely forgot. And I guess it's up 47% from when we entered it in that portfolio to look at your positions there. So remember real quick, if you haven't done so yet, you can test the PowerOptions tools we saw today, the portfolio. We didn't see any of the search tools today. Of course, those are the patented search tools to evaluate the positions, to put in your personal stock and option criteria to see what positions match in the current market across the universe of options. Didn't see that today much, but that's just one of the other tools. We saw the power of the portfolio tools, the what-if scenarios, using that long option finder to see which call will give you the best return if the stock goes in the desired direction. And we looked at the stock repair tool to help us get back to break even and evaluate those also. But yeah, if you haven't done it yet, just go to powerop.com. All you need is first name, last name, and email address. We'll give you access to a 14-day free trial. And then, of course, after that, the subscription levels start at $40 per month. That's for the end-of-day data. Then we do offer a 20-minute delayed service, which is only $60 per month. And there's a real-time service upgrade as well. Now, as we mentioned, check out the blog. Remember, you can see some of that information on the stock or portfolio insurance, and I'll have more updates for you on that next week. And remember, you can go to our webinars page at any time, powerop.com/webinars.asp, or check us out on YouTube. All right. Well, if you do think of any questions later on this weekend or early next week when we see what happens with the market after who knows what goes on over the weekend, remember, send me an email at any time. You can reach me to support@powerop.com. And if you have questions about radioactive trading, you can also reach us at support@radioactivetrading.com. You can also reach us, myself and the other staff members, and Ernie as well, anytime during market hours. Just call the office at 302-992-7971. Of course, remember, your trial members, those of you on a trial, those of you that are subscribers, you can schedule the coaching session at any time. Sam says he's out of Roku at 58. Still looks like a very strong, profitable trade. He says the Roku TV looks pretty nice also. So, all right, we'll keep our eyes on that. All right, ladies and gentlemen, have a fantastic weekend. Take care of yourselves. We'll see what the market has in store for us next week, and I'll see you soon. Take care now. Good night.